How sentiment analysis AI investing predicts market trends. Early artificial intelligence is transforming the world of investing, and one of the most powerful tools in this transformation is sentiment analysis. Sentiment analysis uses AI to scan and interpret the language of financial news, earnings reports, social media, and other text-based data to determine whether the overall sentiment is positive, negative, or neutral. For investors, this is a game changer because markets are influenced not just by numbers, but by perception, emotions, and collective reactions. By leveraging sentiment analysis, AI can help investors predict market trends earlier than traditional methods, giving them an edge in a fast-moving and highly competitive financial landscape. At its core, sentiment analysis uses natural language processing (NLP) and machine learning to analyze vast amounts of text quickly. Imagine trying to manually read thousands of news articles, press releases, analyst reports, and social media posts every day. Even a team of professional analysts would struggle to process this amount of information efficiently. AI, on the other hand, can scan millions of data points in real time, detect subtle shifts in sentiment, and quantify the overall mood of the market. This allows investors to identify trends, anticipate market reactions, and adjust their strategies before others even notice the changes. One of the most common applications of sentiment analysis is in stock news and financial media monitoring. When a major company announces earnings, hires a new CEO, or faces a regulatory issue, AI-powered sentiment analyses can determine whether the news is likely to have a positive or negative impact on the stock. For example, if multiple reputable news sources report that a company exceeded revenue expectations, sentiment analysis models will detect an overwhelmingly positive tone and assign a corresponding score. Investors using this information can make informed decisions about buying, holding, or selling shares before the broader market fully reacts. Social media has become another critical source of information for sentiment analysis. Platforms like Twitter, Reddit, and financial forums often capture market sentiment before traditional media does. AI can detect spikes in mentions, changes in sentiment, and trending discussions about specific stocks or sectors. For instance, if an AI model observes a surge in positive sentiment toward a tech company on social media while traditional financial metrics have not yet reflected this, it can signal an early opportunity for investors. Similarly, a sudden increase in negative sentiment could warn investors of potential market volatility or downside risk. Earnings calls and SEC filings are also powerful sources for sentiment analysis. While these documents are dense and technical, AI algorithms can extract key insights and detect underlying tones that might not be obvious to the human eye. For example, cautious language, hedging statements, or unusually detailed explanations about risks in an earnings call transcript can indicate potential challenges ahead. Conversely, confident language and forward-looking optimism might suggest growth potential. By quantifying these signals, AI gives investors a more comprehensive view of the company's outlook, helping them anticipate market movements with greater precision. One of the key advantages of sentiment analysis AI is its ability to predict trends early. Traditional investment strategies often rely on historical price movements, technical indicators, or fundamental metrics. While these methods are valuable, they sometimes lag behind real-time market sentiment. AI-powered sentiment analysis, on the other hand, can detect subtle shifts in perception that precede actual price movements. By identifying these trends early, investors gain a timing advantage, which is crucial for maximizing returns, especially in volatile markets. However, predicting trends with sentiment analysis is not without challenges. One of the most common mistakes investors make is over-reliance on sentiment scores without context. AI models analyze text data, but they do not understand the full context of market events or the nuances of human language. Sarcasm, complex financial jargon, or contradictory statements can sometimes lead to misleading sentiment results. Investors need to combine AI insights with traditional research, technical analysis, and human judgment to make well-informed decisions. Another challenge is data quality. AI models are only as effective as the data they are trained on. Misinformation, biased sources, and unverified news can affect sentiment scores and lead to false signals. Investors must ensure that the sources feeding their AI models are credible and that the algorithms are calibrated to minimize bias. Additionally, constant retraining and updating of models is necessary because language, market trends, and investor behavior evolve over time. Risk management is also a critical consideration. Even when sentiment analysis predicts early trends accurately, markets are influenced by countless factors, including geopolitical events, macroeconomic indicators, and unexpected news. Investors must use sentiment analysis as part of a broader strategy that incorporates portfolio diversification, stop-loss measures, and risk assessment. By doing so, they can take advantage of early signals without exposing themselves to unnecessary risk. AI sentiment analysis also provides a significant advantage in identifying sector-wide or market-wide trends. By analyzing aggregate sentiment across multiple companies, industries, or even entire stock exchanges, AI can highlight emerging trends that might not be obvious when looking at individual stocks. For example, a sudden shift in sentiment toward renewable energy stocks could indicate a broader market trend, allowing investors to position their portfolios accordingly. This macro-level insight is particularly valuable for U.S. investors navigating complex and interconnected markets. Investors should also understand that sentiment analysis is not about predicting exact prices. It's about detecting patterns and trends. It provides an early warning system, a way to gauge market mood, and a tool to make more informed, proactive investment decisions. The combination of speed, scale, and analytical depth makes sentiment analysis AI uniquely positioned to complement traditional investing strategies and enhance decision-making in real time. To maximize the benefits of sentiment analysis, investors can integrate it with other AI-driven tools, such as predictive modeling, reinforcement learning strategies, and alternative data analysis. By combining multiple AI techniques, investors gain a more holistic view of the market, improve timing, and reduce reliance on any single source of information. This multi-layered approach mirrors the strategies used by some of the largest hedge funds and institutional investors, giving retail investors the opportunity to leverage similar technologies in their portfolios. If you find this video helpful, make sure to subscribe to our channel for more insights on personal finance, AI in investing, market strategies, and stock analysis. Like this video to help us reach more viewers who want to learn how AI is transforming investing. Leave a comment with your thoughts or questions about sentiment analysis, and share this video with friends or family interested in smarter data-driven investing. By understanding how sentiment analysis AI works and using it responsibly, investors can predict trends earlier, make more informed decisions, and navigate the stock market with greater confidence. In summary, sentiment analysis AI investing is a powerful tool that allows investors to interpret market sentiment, anticipate trends, and act before traditional metrics catch up. By analyzing news, social media, earnings calls, and other text-based data, AI provides a real-time view of market mood, helping investors make proactive decisions. However, it is essential to combine AI insights with human judgment, data validation, and risk management to avoid common pitfalls. When used correctly, sentiment analysis can give investors an early edge in predicting market trends and improving investment outcomes.